Assalamualaikum and salam sejahtera. I am Dayang ZARINA Muhammad ZAINI would like to brief our case analysis introduction part. Basically, the Horniman company performance looks strong and healthy if we look at their 2005 financial summary, net income of $60.8 thousand. In the case of the Hornimans, the financial performance appears healthy, but they are not doing well in terms of to have enough income to liquidate their liabilities. Horniman was growing at a quick pace, therefore it is a negative effect on income because they are purchasing supplies, inventory and extra land. Maggie usually pays her suppliers in 10 days for a 2% discount, and they are getting to finance loan of the land due to rate of interest 6.5%. However, Maggie shouldn't be so rigid together with her account payable policy. She should leave some cash to accumulate before she sends out her payments. In addition, Maggie should determine her opportunity cost of whether the 2% discount is worth her making payments in 10 days instead of 30 days. In fact, Maggie should consider financing the acquisition of the land. The erosion of their cash balance are often explained by two factors. First, under the asset section of their record, receivables keep increasing from year to year, which means they are not collecting payment cash from their customer or buyers fast enough or allowing a really long payment term. They can implement a shorter 30 days payment policy or a discount for payment made within 10 days for increasing their cash. Secondly, their inventory turnover is too low. This means that they are purchasing too much inventory and not selling it fast enough. They are carrying over an excessive amount of inventory, which also incur additional cost to the corporate. Therefore, the Hornimans don't have an honest sales forecast model because they are assuming that they are getting to sell everything they need. Afterwards, I would like to pass the next presentation to Muhammad Fahmee to elaborate on financial statement. Thank you.
Hi, Assalamualaikum and good afternoon to everyone. My name is Fahmee. Today, I would like to explain the detail of Horniman financial statement analysis. When analyzing the Horniman financial statement, I found that the movement of percentage around 33% in 2002 being at $788,900, and during 2005 the revenue is increasing $1,048,800. They have stabilized their depreciation as it only 20% from 2002 to 2005, which is every depreciation around $34,200 to $40,900. Meanwhile, the tax expenses did not increase dramatically by staying around 34 to 39%. We look into the current asset have increased 19% and total asset increased 14.4%. This is due primarily to the increase in inventory and account receivable. In the 4 years from 2002 to 2005, inventory have increased 8.7% and account receivable has increased 16.4%. This is due to this, the cash balance has decreased from $120,100 all the way down $9,400. In addition, in 2005, the cash balance went below their comfort level of $10,000 down to $9,400. This situation is not meet their expectation of 8% minimum of total revenue target. Hence, based on the analysis, I would like to explain if they continue to increase their net working capitals like they have in the past, the project net working capital for 2006 would be negative $235,900, which would cost them a negative cash balance of $193,000. We will continue with the financial ratio analysis and will be presented by Ms. KHAIRUNNISAK. Thank you.
Assalamualaikum and salam sejahtera. My name KHAIRUNNISAK ISMAIL, and today I would like to explain the details of Horniman's financial ratio analysis. By looking at the financial ratios, even though they are increasing in sales, they are relaxed on their accounts receivable and credit terms. Each year, it takes them longer to collect their money. This is due to the fact that the carrying cost of inventory is harder for the smaller customers to endure. To add to this, Bob has to put a bigger investment in his inventory because of the more mature plants. It takes 2 to 5 years to grow because of the increased demand, for instance, landscape. Finally, they are paying out cash significantly faster at 9 days than the benchmark of 27 days in order to receive their 2% discount. To summarize it, they are holding their inventory longer, collecting on payments slower, and paying out cash faster, which in essence in destroying their cash balance. This is a good idea to cut costs and have more cash available, but the business is not receiving payment from their customers in a timely manner. This is shown by the 9-day increase in receivable days since 2002 from 41.9 to 50.9. Horniman Horticulture is profitable and sales growth exceeds all industry benchmarks. The cash flow for the business remains a problem. In 2004, the business days sales outstanding were more than 2 times of the industry benchmark. Operating improvement create a cash flow problem. Next, I would like to pass this presentation to my friend NURREL IQRAM for the next elaborate. Thank you.
Hi, good afternoon everyone. My name is ISMAIL IQRAM bin ABDULLAH. Today, I would like to present the detail of Horniman's competitive for growth. The analysis show that any and all acquisition operation cash flow is a being distributed to the net working capital, which allow for a zero balance for free cash flow to the Bob and Maggie. As a result, the business has actually been acting in a way at the cash reserve act has the have. To stop the errors to the cash, Bob and the Maggie can reduce the amount of the money they are investing, improve the payable and receivable day, and consider taking on some debit finishing. Referring to Horniman's culture balance sheet, which later grow coming in 26, Maggie and Bob need to look into the cash balance and figure out what they will need for pension to avoid a negative cash balance, which can put them into the bankruptcy, which reverses increase a very year and dramatic increase from 25 to 26 by 30%. The need of forecasting cash balance signed to do not pay out any cash dividend. The rate of growth to the ROC ratio has the return of the capital has been average of 30% in the 4 years. The unpredictable increase in the view from 50% to 30% will most likely not support the much longer. The need for finishing to compatible balance this continued growth is the need of yet bankrupt.
Hi, Assalamualaikum. My name is AZWAN bin NORSHAH. Based on our finding, here with some recommendation for Bob and Maggie. If the cash reserve continues to fall, the growth of the company could be stifled and will eventually go under. Bob and Maggie should relook into customer policy for patrons that either have large order consistently throughout the year or a patron that always pay yearly the amount that they own. Other than that, both sure to stray away from their new business strategy and easily settle down on the matured planned inventory. This could be a way better idea once they found out their cash problem and include the asset turnover in order they're closer to the 8% revenue. Another option is for them to not always pay the supplier in the 10 days to obtain the 2% saving. If they will figure out the system to find a way to occasionally get the 2% discount offered to them by their supplier to save some money but also hold on their money some of the time and pay at the 30-day due date, they could see a massive chance in the short-term liquidity problem that they are seeing, and that could really help reduce the cash on hand problem. They could also adopt some form of payment reward plan like their supplier have for customer to buy rather large quantity of inventory and take a percentage of the amount on or for payment they are before a certain date.